think I pushed all the right buttons here. So we are live together. And it is the middle of November, November 15th. And it got cold here since the last time we spoke. It was chilly 2 weeks ago, but boy, it got downright freezing out here in the last couple of days. I don't know how you're doing down there in Georgia.
Well, it's cool down here too, but the stock market is just going gangbusters. So that warms me
That's
up.
on fire.
When I stay inside, I was thinking, man, we're doing pretty good. Speaking of, you're sort of the keeper of our portfolios, and give me. And I know both you and I have our biggest commitments of personal assets in the moderate Stone Barn portfolio. Give me a shorter term update on, say, the last week or two, or today. I don't know, because I really hadn't looked. I've been at a Thanksgiving at an elementary school and had to go to 2 lunches. So you better talk fast today, because it's hard to keep me awake. So.
Boy, what grandparents and great uncles won't do for for their nephews, nieces, and grandchildren, huh?
Yes.
Okay. Well, let me tell you. Let me give you fill you in a bit. It hasn't been a bad month so far, month to date, for our NDX moderate model. The like you say, you and I have a very, very large percentage of our personal assets invested in that particular model, and so we watch it very closely. I actually get a report every day on how it did the previous day relative to other indices. And we saw in the first week or so that the model did not keep up with the indices. That happens from time to time. It's not anything unusual for us. But in fact, we had a couple of down days, small down days, while the market was having some pretty strong up days. Now, if you were only going to look at this in the window of a week, you might get worried, but having watched this for months and months and months, I can tell you that this is quite ordinary. We saw, in fact, this past week, kind of a reversal of that, where the model itself actually had the let's say performance over 50 basis points for a day, while the markets were actually down a little bit. So it goes back and forth and back and forth. But the point for us is, I want always for you and me to keep in the back of our mind, and for our listeners, for our investors to keep in the back of their mind, the idea of that perfect portfolio, which is a straight line, and that is the ideal that we are aspiring to. And what that means sometimes is that we don't go up as fast as the market. At the same time, we're trying not to go down as fast as the market when the markets go down. So we're trying to do the best we can to create as straight a line as possible over time, and that means having weeks like this, or occasionally seeing a week or two where we're underperforming the index. Indices are making new highs. Today looks like it's going to be another record for the S&P and perhaps for the NDX. I don't really watch the Dow, but I know that's doing the same thing. So hey, we'll take new highs where we can get them, even if they're not quite as high as the markets are making at any given moment. But that actually kind of leads into something that I wanted to talk to you about. You and I have taken a look at a couple of charts over the past couple of weeks that kind of really resonated with us in helping to understand why a straight line or a low volatility approach to investing actually makes sense. With your indulgence, I'm going to bring up a PowerPoint and kind of ask you to walk us through this, because it's a pretty amazing from a statistics standpoint. Sound good to you? All right. There we are. This is the beginning of the PowerPoint here. You tell me when you want me to click, but
well, Paul, to start with, we're at a time right now where everything's great and wonderful, and people don't worry about the market. We're going to make new highs.
It doesn't take brains right now; it just takes guts.
Yeah, even some lesser skilled people are making money, and this little two or three little PowerPoint things really puts it in perspective. Because if I ask the average annual return of the S&P 500, the NASDAQ 100, these are just the big broad indexes so far over this century,
Okay.
we're approaching 20 years. And I'm giving you a little bit of a hint. Since the low after the financial crisis, the S&P 500 is up 347%, and the
Yeah.
NASDAQ 100 is up 678%.
Wow.
Just think about that. Now that is a lot of up capture
That's a
as
lot of
markets
return.
are going up. And
It makes the case.
question.
It kind of makes the case for buy and hold, doesn't it?
Yeah,
What do
but
you
just
think?
go back to the average annual return. Now, I didn't
Okay.
compound it or anything like that. This is just that if you go out and talk to people and say, oh, over the last, probably since the low in '09, the NASDAQ is probably compounding at about 20% a year.
Mm.
But now you might sneak into the next slide and see if we can
Yeah, let's take a
just
look.
in a perspective for us.
All right. Hang on. I'm gonna shut down these little pictures of these two good-looking guys here. There we go.
Yeah.
Yeah, look at this. That 347% you were mentioning there, that rightmost green arrow, that is really impressive. Now it's not a straight line.
No,
I mean,
but
the arrow is, but the market itself isn't a straight line. In fact, it's got quite a bit of volatility in here, doesn't it? So, what do you think? Let's take a look at these individual legs. All right.
all right, let's fire away. As I said, all right, back in 2000, we had a bear market, and I'm being rather generic in my. It was a little bit more than 50%, but
Mm-hmm.
the first bearish part of the 2000, we had a little 50% takedown,
Mm-hmm.
and we had a pretty sharp up rise of 100% from the low.
Right. Yeah, so we went right back to where it was actually.
Lose 50, it takes 100 to get even,
That's right.
Then we had another 50%er, and then we had this big long one where it was up 300 or 400%. I don't know what it was, 300. Yeah, 300.
Yeah, 350%.
And if you to go back to my original question, what do you think that over that period from the blue line, from the low to the high, which is the straight line concept that we're always talking about, that virtually never happens?
Right.
If
from here to here, yep. Okay, from the top of the tech bubble here in 2000 to where we're making new highs today, the total return, is that what you're asking?
Yeah, you can put it, just click it. I can't even remember after doing it.
Oh,
what I was really after is the average annual return. And I believe I can win some money off of this one, because if I ask even semi-intelligent people in my profession, they couldn't even come close. I mean, all of the guesses would be somewhere between 6 and 12%.
Yeah,
because it's pretty obvious that we went through about a 10-year period from 2000 to that 08, 09 bottom down there.
Mm-hmm.
We had some pretty rough stuff to deal with, but over the last 10, 12 years, we've just been been going straight up. It's just been, and there's where we are today. This is exactly where we are. But the truth is, we have a strong belief that as we turn down the next major downturn, this is what Stone Barn will bring to the table that virtually no one else will. Is we'll take an action that will be after the fact pretty good for us.
That's right. I mean, a lot of people point out that if you miss, X number of best days over the last 20 years, your return isn't very good. The other side of the coin is if you could miss X number, an equivalent number of the worst days in the market, and put that together, you actually end up with attractive return with less risk. Of course, that's what we're always trying to do. We're always trying to avoid as much as possible these incredible downdrafts. Here, this is from 2000 to 2008. That's an 8-year period that it took you to get back to even. You know, you spent 8 years underwater here if you were a buy and hold investor, just trying to get back, and you needed a 100% return from 2003 2008 just to get back to even. Now, if you could take most of this out of there, then if you can grab, you know, that same kind of return, you end up way, you know, above where you would have been. So missing these down things is incredibly important. But it even makes more sense when you look at the NDX, doesn't it?
Yep, absolutely.
Well, let's take a look at that. Now, this is
Okay.
the same chart, right? Same
Yep,
thing.
same time frame, 20 years. And some of the people may not be able to remember back to the year 2000, at the start of the century, but unfortunately, me and you can remember way before that. So,
Oh yeah,
but
yeah,
it was rather devastating in terms of return function. But look, you know, we all want to look over here. This 678% gain. That is what people talk about,
right.
and it has been awesome. I'm
Yeah,
telling you what, it has been a blessing to do that.
yep.
But go ahead with the rest of the PowerPoint, and you'll see some of those. Here's another one made 171% in there. Go
Yep.
ahead.
Yep.
Then we had a little.
That was the financial crisis.
Yeah, we had a little financial crisis there, but over here
The
after
tech
the tech,
bubble.
whew, I
Yeah.
mean,
You can't lose 80% of your investment funds and expect to make that up fast.
yeah, I mean, we spent I don't know how many years, probably up into the.
Well, let's see. Let's look at this dotted
Yeah,
line here. Look at that dotted line. Took over until 2015 to 26, 15 years underwater before you got back to a high, back to where even.
yep.
Wow.
So while we do like the Nasdaq 100,
Yeah.
getting to the blue line concept, and take a look at the average annual return is less than 3%. And let me give you some more bad news about that kind of return. That has no factor in it for cost, for taxes, inflation. So in reality, while they cheerlead a little bit over the last, I can't remember what the returns, you know, since '09, that's pretty devastating. You dig out of a pretty big hole there. And when you average, just your average annual return is only less than 3%.
Yep.
You could almost take a bond or something and produce that with much less volatility. But
Yeah, that's right.
this is just a picture book example of why we're so cognizant. There's probably, I know there's not more than a week it goes by that we don't have a personal chat about what's the status of our measures as it relates to being prepared for the impending bearish regime that's going to come. We don't
Right.
know when, we don't even know why or how, but
Right.
we're going to know about it, and we're going to take an action to avoid a lot of that down capture.
That's right. And you know, even those who were invested last year at this time, the fourth quarter of 2018, which is this big downdraft here, that was almost a 20%. Well, for the Nasdaq, it was a 20%.
It was, yes.
20% drawdown, losing 20% of your money. That happened over the course of about 2.5 months. You know,
Yep.
you're 10 weeks, lose 20% of your portfolio. At this point, I guarantee you that a lot of people were thinking it's going to be this all over again. It's going to be the tech bubble bursting, or it's going to keep going. You know, why would it stop at only going down 20? Well, it bounced, and it bounced very, very quickly. I'm not sure everybody saw that coming, but in the middle of all this, our moderate portfolio, our moderate model, we were down about half of that, not quite half of that. And we were actually, this is, I guess it's probably February or so, but we were making new highs in our portfolio in January.
Absolutely.
And yeah, so that's what you got to do, and that's how you have to invest. Um, we're still just absolutely thrilled with the way that the models are holding up to their testing and the way they're performing in the real world. So it's exciting, really is exciting. What do you think?
I think it's pretty good because that's where I got my pennies. And I also think it's a something that's valuable. I think a lot of people can pick decent funds or ETFs or stocks or whatever. Very few people really have the ability and the skill to step and say, we're in a bearish regime and the markets are going down, and then even if you have one of those whipsaws like last year, they don't know where to get back in. That's the blessing of a model,
Mm-hmm.
concrete driven with our decisions. It's really not a matter of to us, do we like it or do it? Hey, we have to follow. We're mandated. This is what we're tasked with to do that. And I like it. I usually could blame my wife or you or somebody else. Now we got to blame the model. See, so
That's right.
we follow it without any question.
Well, I used to blame the most recent investor. Guy would come along after a couple of good years and he'd say, "Oh, this is great. I want that too." And he put his money in and the market was tanking. So we'd have to blame him.
Well, it's not easy, and it's the ultimate challenge. But we're doing well. I mean, I feel very comfortable that we're doing what we're planning on doing. And
well, you mentioned something about if you get scared out of the market during one of these downdrafts, the real problem then is when do you get back in and how do you get back in?
It isn't one decision; it's two. To get out, right. And then you got to get back in again. That's even harder.
It is very, very difficult because the best time to get in is when the market's looking its worst. And that almost never happens. But I'll remind our investors that and our subscribers that while 2018, that fourth quarter was happening, we were fully invested. We were only down half of what the market was, but we were fully invested at the time and making new highs back along in the early part of January. So that's a critical part of it. Having the discipline, having the faith in your approach, and I'll tell you what, watching this work over the last this protracted testing period that we've been going through has been really, really, really fun to watch it work like it's supposed to.
But I'm happy we're making all-time new highs.
Yeah,
my guard is not going down.
Well, we're going to give some of that back. I can tell you, we're going to give some of that back.
Yeah. But the reality is that we have a plan, and I personally can tell you that I have managed assets through the last two bear markets that we saw in there, and our models will do a credible job as we go forward.
Yeah, there was a that always helps. There was a gal, I don't know if she's still around or not, but she used to offer trading models on a website, and Trader Janie, and interesting gal, but she had a saying. I think her business motto was plan your trades and trade your plan. And that goes a long way to talking about how you have to you do what your models tell you to do. When I owned a company that tracked individual managers and their models for years, and I guess we tracked over 2,500 models over a 10 or 12 year period, and I can't tell you the number of those models and managers that would hit a rough spot and then completely change their model. Mm-hmm. Or they would override their model, or in the middle of it they'd throw in a new filter on the model, so you'd get some really over engineered and approaches, and you never knew what was working. It was like they kept changing, and so that's something that we're not going to do. Yep. All righty. Well, this is good stuff. I love those charts you put together, that PowerPoint you put together. That thing really, that's impressive.
It's the real story that I've personally and you've personally dealt with over the last 20 years. And while I am ecstatic that we're doing well, portfolios at all-time highs, markets are at all-time highs, I'm not so comfortable that I don't look at it every week.
Well, it's like I said earlier, it doesn't take brains right now. It just takes guts. You just have to have the guts to put your money in the market. The brains part comes when the market is not making new highs, when the market is making new lows on a consistent basis. That's where the brains and guts come in, and that's where the real value add is for us in our approach. Trying to avoid the worst that the market can offer, or to exploit it is a better way to say it. It's not just a matter of avoiding; it's a matter of exploiting it. And one of our exploits, as we've talked about in other videos, is a hedge, and that can take a lot of the pain out of a wicked market. Anyway, we're starting to talk a lot of jargon here, and some folks like that, but other folks are want to speak English. And my suggestion, if that's the way you feel, is that watch some more of these videos. Read through our website some more, and some of this jargon will make more sense to you. And we do try to keep it down to a level that we think everybody can relate to. We intentionally try to do that. But sometimes we just get ahead of ourselves and start talking like
I want people to know how smart
insiders.
That's enough. Stop.
All righty. I'm going to say goodbye. I'm going to say goodbye before we get ourselves. All right, talk to you soon.